conversation. Let me quickly introduce our guest today. We've got Devang Shah, who is the co-head fixed income at Axis Mutual Fund. Thank you so much, Devang, for waiting by. I was keen on playing out those bites of the RBI governor because it sets the stage for our conversation. You were anticipating this, I think, broadly. How does one, or let's start with your initial reactions to the policy. How do you expect things to pan out from now, from this point, and how do you see the yield curve progressing? What do you read from today's move itself?
Sure. So I think if you ask me, if you look at I'm sure you read through the entire policy and the document as well as the entire commentary from MPC and the governor has been very, very dovish. If actually he's still more supportive for the growth, he's worried about the possible downside risk to the growth on account of the new variant of COVID. And hence the entire, I would say the conversation and the entire thought process of RBI today is that they have to ensure that growth is back on track. If you ask me, we wouldn't not have got any dovish policy then today in an environment where somewhere down the line, the macro environment is picking up. You look at economic activities back on track, pre-COVID levels. I think RBI did mention about the fears of inflation creeping back, and we have seen a reversal not only of food inflation, but also commodity inflation, which is persistent and sticky. So our view, if you ask me, is that yes, policy is very dovish, than what market was expecting. Hence, we actually saw some 3 to 5 basis of rally across the curve. We have seen some, despite the liquidity measure which RBI announced, we have seen short end, long bonds, everything remain positive because markets were pricing in some kind of forward guidance, or markets were pricing in a part of the market were pricing in some kind of a small token reverse repo rate hike in this policy. So a slightly positive surprise by the RBI's thought process of continuously being conservative and being more accommodative and dovish than what market was expecting.
Which is something that the second was pointed out by a few observers. Yeah. We'll get to that, Devang. I'm saying which is pointed out by a few observers in that this is, at the end of the day, an inflation targeting monetary policy committee of the central bank, and the RBI governor is maintaining, of course, that is indeed the objective of the central bank to keep those to keep inflation in check. But he's also admitting that you could see a spike in the second half of the year on account of the low base effect of last year, and also what is panning out on the commodities side. So do you think that eventually they will have to act on inflation? And also, how do you read the moves that were made on liquidity? There seems to be some effort to make the longer variable reverse repo auctions more of an avenue to suck out that excess liquidity.
Okay. So a couple of points. I think probably if you ask me, for us, when we look at the near term, I think yes, inflation prints on the higher side, but on the medium term also, we believe so that inflation will continue to bother RBI, and hence RBI will have to move the buck. The RBI has been very, very comforting and ensuring that the move is slow and gradual and non-disruptive. And hence we believe so that in the near term, the yields will trade in a range-bound level, but yields should start trending upwards. From a perspective on medium term as well as near term, I think the move will be slow and gradual, but directionally yields will go up. On to the second question where you spoke about liquidity, I think, this is a February 2020 RBI circular, which talks about that they want to keep the 14-day variable reverse repo rate auctions, which is the VRRR, which RBI calls, as the operative rate. Today, if you look across RBI, the total banking liquidity is close to 10 lakh crores, okay, out of which approximately 6 to 8 lakh crores is being withdrawn by the longer term variable reverse repo rate auctions, and 2 to 2.5 lakh odd crores is being withdrawn every day from the banking system by the daily fixed rate option at 335. Most of the variable reverse rate auction cutoffs are in the band of 375 to 399 already. They have to be below the repo rate, and hence the entire cutoffs are between 375 to 399. My view is this liquidity move, which is moving towards a 14-day operational level and probably making the operative rate of 14 days VRR, will slowly lead to inching up of the operative rate today, which is at 335, the TREPS rate, the overnight money which gets deployed, or the call rate and the money market rates will start inching and trying to price in the higher operative rate. The operative rate will move from 335 today, probably in the next 1 to 2 months before the next policy, closer to 360, 365. So indirectly, even though RBI has not done an RR hike, this liquidity move will lead to the short end of the curve trending higher due to this overnight rate as well as the expectation setting higher for the operative rate.
Fantastic. So that sets the context for the next question, and I think that's the operative question really, Devang, which is how does the, and we discussed this also, if some of the viewers are familiar, just last week when we were talking about what the Fed did and what the Fed was saying in terms of durable inflation. But how do we move? You're saying that on the longer end, you expect that yields are likely to be range bound, at least in the near term. But the fact is that they have already moved higher. You're also saying that on the shorter end of the spectrum, you're pricing in certain aspects that are changing on the liquidity front, and you're seeing those rates also firm up a little bit. Over what period do you see those changes, and could you take us through some levels that we can anticipate in say, for example, the next 4 to 6 months?
Sure. So I think, see, today, if you look across it from our perspective on the three sides, which is the operative rate, the short end of the curve, as well as the long bonds. The operative rate, we believe so that probably from here till April, you should start looking at a 4% kind of an operative rate. Today, we are at 335. We believe that RBI will be slow and gradual, moving towards a 375 reverse repo rate. And RBI's endeavor is to keep liquidity still accommodative and positive, but slowly move towards between 375 to 4%. So if you look across an operative rate perspective, we are trending from 335, 340 currently to probably between 375 to 4% by April. On short bonds, I think the current levels for 1-2 year corporate bonds are between 4.5 to 5%. I think on the short term levels, the move in bond yields will be closer to the tune of 25 to 30 basis in the next 3 to 6 months. Long bonds, which are currently 10-year government bond, which is the benchmark levels and which are very easily replicable and visible by all the investors. Today, they are trading in the band of 630 to 640. What we believe is with all these measures, including liquidity as well as RR hikes, we believe that, and budget being round the corner, where we again believe that budget will be a key driver for the direction of interest rates next year. And we believe that budget again will be very, very growth supportive. The long bonds also should trend towards from the current level of 635 to probably 6.5, 655 levels. So where do I look at the curve? I think probably the extreme repo rate 25 to 40 basis higher. When it look at the short bonds 15 to 25 basis and long bonds 10 to 15 basis higher. And curve should flatten.
Okay, so the curve will flatten. You've given us your expectation as to how you expect this to progress. But I want you to also talk to us about a little bit further down the line, okay? And this being an inflation targeting central bank, on the policy rates, how do you expect things to move? Because the Reserve Bank governor also talked about Q2 or Q1 and Q2 of next financial year, and he's talking about inflation at 5% levels in Q1 and Q2, and that's not maybe factoring certain changes that could come about. He's saying there are upside risks on account of commodity pressures globally, and that certainly is something that is concerning the central bank. So assuming that doesn't come into play and you have 5%, that's still relatively elevated. It's towards the higher end of the spectrum that the MPC keeps. So how do you expect policy action to play out in the new financial year?
Sure. So see, I think a couple of things here. So to set the tone right from the inflation targeting perspective, flexible targeting perspective, as well as the inflation rate, which RBI believes on the current mandate is 4% plus minus 2%. So they can go up to 6% and that is a tolerable band for them. again, the entire focus at that point of time when they're looking at inflation, they also need to take into account the output closure, the output gap, which is currently being there thanks to COVID, and as well as the slowdown in economy, which we have witnessed for the last 2-3 years. All on so being certain about the growth cycle, I think somewhere down the line, and if the budget is very, very pro growth, and where the governor as well as the MPC gets comfort that now they no longer see any kind of big downside risk or surprises on the growth cycle, I think probably we are looking at the repo rate in the next financial year to be hiked by at least 50 to 75 basis. So we believe that in the current juncture where we are looking at CPI closer to 5.5, 575 for next year, as well as output gap still needs to be closed. There is a lingering risk of the new variant of COVID. RBI might want to be slow and gradual for the first few months, but next financial year we can look at a good 50 to 75 basis of repo rate hikes.
Understood. Now, given all of this, Devang, what was the... So I'm guessing that it doesn't change the advice that you gave last week in terms of how someone should position themselves in the construction of their fixed income portfolio. But for those people that did not listen to that conversation, I'm going to ask you again. Given what we know, given the fact that you expect that the yield curve is going to flatten, you expect the long bonds yields to go up in the medium term at least, how should one position themselves as far as their fixed income portfolio is concerned, and how does that change over the course of the policy changes that you expect to pan out?
So, see, our view is that actually, if you ask me, except for my governor being or the MPC being more dovish than what we anticipated, the course of reversal as well as the rate hikes continues to be the same as we had discussed last week. We still believe that by April, we are looking at for 3.75 to 4% operative rate. We are going to back to normalization. And post that, depending on our views on economy growth as well as inflation, where there are upside risks, as you rightly highlighted, we believe that RBI will start hiking rates. With that backdrop, our view continues to stay invested in the lower end of the spectrum of duration. We believe that curve flattening theme is the most important element which will make money for investors next year. Carry is what you need to ensure to be built into a portfolio, because curve flattening will help you to provide a hedge against rising interest rate environment, and carry will protect you against any kind of downside risk. A combination of these two aspects, what we are doing across our funds and advising clients is to invest in products which are lower end of the duration, which is the ultra short term type of strategies, curve flattening, which is being used across those strategies, and lastly, build upon credit wherever possible, either through floaters or through AA, single A assets. Because a combination of these two will provide you a hedge against rising interest rates. So carry through credit funds, carry through curve flattening short-term bond funds, and floating rate funds continue to remain with lower duration maturities and durations, continue to remain our prime advice to investors for the next fiscal year.
Thank you so much, Devang, for spelling that out. And by the way, viewers, in case you did not understand any aspect of that, in terms of what Devang was pointing out, in terms of carry, in terms of credit, do write your queries to us. We've got a WhatsApp number that will flash on the screen intermittently, or you can write to us on any one of our social media platforms, and I'm sure that we can get those queries answered. Devang, as usual, a pleasure speaking with you. Thank you so much for the insight that you provided.
Thank you. Take care.